American factories just posted their hottest month in 4 years. On the same day, oil crashed 7%. Both of those made the Fed's September decision harder, and one of them is going to be proven wrong about where this economy is heading. By the end of this briefing, you'll know which side the money is betting on. Stocks rallied, the Dow hit a record, and the fight we've tracked since Thursday just got its first real data point. Here's the timeline. Yesterday's map said jobs week climbs a staircase. 5 days of data, ending with Friday's jobs report at 8:30. Monday was step 1, the ISM factory report, and it did not step quietly. 55.6. Economists expected 54. June was 53.3. That is the strongest factory reading since May of 2022, back when the Fed was starting the fastest hiking cycle in a generation. Remember the 3 dissenters who voted to raise rates because the economy is running too hot? This number is their Exhibit A, and it landed on the exact same day their other favorite argument, expensive energy, fell apart at the seams. 2 data points, 2 opposite verdicts. Let's walk it. Start with the factories. The ISM Manufacturing Index measures whether factory activity is growing or shrinking. Above 50 means growth. 55.6 is not just growth, it's acceleration. New orders up, production up. The strongest expansion in 4 years. For the inflation hawks at the Fed, this is exactly what a reheating economy looks like. You do not cut rates, their argument goes, into a factory boom. If anything, you hike. Markets heard the number and did something strange. They rallied anyway. The S&P closed up 1.25% at 75.82. The Nasdaq jumped almost 2%. The Dow closed at a record, above 53,000. Why would stocks celebrate data that strengthens the case for higher rates? Because of what happened in the oil pit at the same time. Sunday night, we told you oil fell 5% on news that US and Iran talks were resuming. Monday, the slide didn't stop. West Texas crude finished down 7.1% at $78.64. That is one of the largest single-day oil declines in months. And it happened while factories are booming, which almost never occurs. Booming factories usually mean more energy demand, higher oil. Instead, the war premium is draining out of every barrel faster than the economy can burn it. Gold told the same story, easing to around 4,090. Energy stocks were the only sector in the red, down over 1%, while the rest of the market partied. The tape is voting that peace is deflationary and that cheap energy will smother whatever inflation the factory boom creates. So here's the collision, and here's the answer to the question from the top. The Hawks now have the strongest factory print in 4 years. The Doves have the steepest oil crash in months. Both camps walk into Friday's jobs report holding better cards than they had last week, which means the jobs number stops being one data point and becomes the tiebreaker for the entire September decision. A hot jobs number plus hot factories, and the hike case is suddenly alive and credible. A weak jobs number and cheap oil plus soft labor ends the debate in the Doves' favor by lunchtime. Which side is the money on? Look at the record Dow close and the 2% Nasdaq day. Equities are betting the oil crash wins. That energy relief beats factory heat. That is a bet on the referee, not a verdict. Friday, 8:30 settles it. What Monday means for your money, not advice, structure. 3 things, fast. First, this rally is now leaning on one assumption, that the Iran diplomacy holds and oil stays down. Same as yesterday's warning, one headline can unbuild it in an afternoon. If you're carrying more risk this week than you can sleep through on a reversal, that's the thing to fix before Friday, not after. Second, watch what the hot factory number does to rate expectations, because that's what moves your mortgage, your car loan, your savings yield. A 4-year factory high means higher for longer stays on the table, even if hikes don't. Cash still pays roughly 3.5% to wait. In a week that will decide the rate path, getting paid to be patient is still the only free lunch on the board. Third, the staircase continues tomorrow with the JOLTS job openings report, then ADP Wednesday claims Thursday, jobs Friday. Every step either confirms the boom or breaks it. You don't need to trade any of them. You need to know that the people setting your cost of money are watching them in real time. And now you're watching what they're watching. Nothing here is financial advice. It's the map updated at the close. Your money, your call. Today's question, and I want your honest read. When factories say boom and oil says relief, which number do you trust with your money? Blue pill, trust the relief. Cheap energy smothers the inflation risk. The Fed stands down in September, and the boom becomes a healthy one. Records keep coming. Red pill, trust the heat. A 4-year factory high with easy money coming is how inflation round 2 gets started, and the market is partying at exactly the wrong moment. Blue or red, drop it below and tell me what Friday's jobs number would have to show to flip you. New this week, the timeline now drops 3 times a day. Macro at 7, crypto at 9, AI at 11, every morning Eastern. Same job every time. The forces moving your money before the market spins them. We watch the forces. You keep the decision, the timeline keeps moving. We will see you in the next one.